Hi everyone, I'm Andrew Jordan, and this is the first video in our series about SBA loans. Let's talk about why an SBA loan might actually be better than a traditional loan, even though the interest rate tends to be higher. That sounds a little backwards at first, but let me show you why that is. Let's say you need $1 million loan. With a conventional loan at 7% interest over 5 years, your monthly payment is about $19,800. With an SBA loan at 9% interest over 10 years, your monthly payment drops to about $12,700. So yes, the SBA loan has a higher interest rate, and yes, over the life of the loan, you'll pay more in interest. But from a month-to-month perspective, that difference in monthly payments, roughly $7,000, is huge. Now, personally, I'd rather be done in 5 years than 10. But if you're growing a company, that cash flow difference can be the difference between being able to take opportunities and having to pass them up. Maybe at the start you can't afford nearly $20,000 every month, but $12,700, that might be doable. And if that financing lets you grow, at some point you're making more money and you can start throwing extra toward the loan. One big advantage of SBA loans, at least as they are right now in 2025, is that they don't usually have prepayment penalties. So you can use the lower payment to buy yourself flexibility at the beginning, then once you're stronger, accelerate your payoff. You're not locked into taking 10 years to pay it off unless you want to be. Another thing you should know, SBA loans often come with additional upfront costs and fees, things like guarantee fees, packaging fees, closing costs. They're usually rolled into the loan, but it does mean the loan balance you're paying off can actually be higher than the amount of cash you walk away with. It shouldn't be a deal breaker in most cases, but it's something to be aware of when you're comparing options. This is how I want you to think about it. Loans are literally renting money. And from the bank's perspective, that's not just a metaphor, that's exactly what they're doing. They're in the business of renting money. And just like with buildings, renting isn't always bad. Financially, buying is sometimes better because you build equity and you save in the long term. But leasing a building can make perfect sense. I lease my office space. I love the location, it's affordable, and when something breaks, it's not my problem. There's less risk. Similar with loans. A longer-term loan costs more overall, but it lowers your risk and it keeps you flexible. And sometimes the flexibility is exactly what your business needs. Another big piece here. SBA loans are designed so that you don't have to have a ton of collateral to qualify. Traditional banks want two things. They want proof that you can make the monthly payments from like a cash flow perspective, and they want proof that if things go bad, they can still get paid back by liquidating your assets. SBA loans work differently. The government steps in and says, we'll share some of that risk, which means you can still get a loan without having as many assets supporting it. That's not reckless. What's reckless is going with a predatory short-term loan with crazy rates. That's actually reckless. An SBA loan isn't that. It's a structured tool meant to help you build. So yes, if you can afford a conventional loan, that can be great. But especially if you can't, the SBA loan might be the tool that gives you room to grow, to expand, and to succeed without being crushed by payments too big for where you are today. Because at the end of the day, remember, you're renting money. And just like leasing buildings, sometimes that's exactly the right move.